our product was out of the gate, was a development only strategy in 2021. And while it was the bottom, like we didn't appreciate that at that moment, investors, they didn't need to build alpha. They were just buying distress. So people, the guidance we got with it's just too soon to be doing development. We were stubborn about it and we ended up getting it done, but we could have been less stubborn about continuing to knock on that development only strategy. What it did do was though give us a focus to shift and then add another business line, which is the direct business that's focused on existing product.
Jerome, welcome to the show.
Hey, good to see you.
For our listeners who aren't familiar with who you are or your firm, can you take just a moment and introduce yourself and the platform, please?
Sure. Jerome Nichols, president and co-founder of Standard Real Estate Investments. We're a boutique, diversified manager. We have a direct business and an indirect business. We operate nationally.
Awesome. Well, part of this conversation is going to be part of our series on kind of lower mid-market alpha and this idea that kind of emerging and next-gen managers are really kind of at the vanguard of what's happening in the market. So I'm excited to have this conversation with you and learn a little bit more about your background, the platform, and kind of where you see opportunities in the market. Before we get started, I like to always just understand the story behind the story. So where'd you grow up? How'd you get into the real estate business? Did you come from a real estate family or have exposure prior to starting Standard?
Yeah, I am from Maryland, back and forth between DC and Maryland. I did come from a family in real estate. I like to draw a hard distinction between real estate family and folks who were in the business. My dad was at a couple of county governments in the Maryland area, worked at Fannie Mae for 10 or 12 years for a development company here in town. So I grew up around the business thinking that ultimately I'd be a real estate guy. Took some turns along the way, played some football in college and then a journeyman NFL guy as well. And after that, got back to real life and landed at Bozzuto in Maryland in the construction group. So in-house construction and development company along with property management, and learned a lot during that period of time. And then ended up transitioning through business school at Chicago to CBRE Investors, where I met my then manager, now partner, Robert. 6 or 7 years at CB, did a post-MBA rotation. So learned, everything there is to know about the institutional investment management business. Spent some time with the CEO in our strategy group on some M&A work. Did a stint in our private equity group doing value add acquisitions for our value fund, and then time with the separate accounts group, and ended up landing ultimately in the funds group with Robert running a development fund. Ended up growing into the deputy portfolio manager there. Robert was the portfolio manager. We ran a series of 5 funds, not quite $4 billion in GAV over the time we were there. Had good seats, successful run. And in 2020, had fully invested Fund 5. Fund 4 was stable, and Fund 6 was on the shelf with every other fund that was post-COVID. And we were both turning 40 and working from home and having our own respective midlife crises, and said, you know what, if we don't start our own shop today, we've got to wait 10 years for the next big one. So we did. And that was Standard.
Excellent. And Standard was started in September of 2020, if I'm not mistaken.
We sent the resignation papers in September of 2020. We started the next moment. In earnest, we started in early 21. But yeah.
Excellent. We're going to come back to Standard in just a moment. But before we do, you glossed over what I think is a really interesting stop in your career journey as a professional athlete. I know that you played college football and then you spent some time in the NFL. Reflecting on that, kind of how does that, how has that impacted your kind of professional journey post NFL? Obviously, that's a big commitment, obviously, to be able to play at that level and make a team.
Yeah, it was a good time. Call it 2 years on and off. DC, Green Bay, some time in Europe, some time in Philadelphia with the arena team. So true journeyman and probably 80 pounds ago, but a lot of hard work, a lot of good fun. But the idea that nothing I'm going to do in this business is going to be as hard as some of the things I did in that business. And so you just have a work ethic that carries you through in a kind of by any means necessary mindset. I think the other thing that is interesting about a lot of sports, but football in particular, is you have a locker room that has all kinds of people that have a common goal, and they're from all over the country. They're from all different walks of life, all different, backgrounds, races, and you've got to figure out a way to corral everyone, learn the same thing, coordinate, and get it done. And that feels to me a whole lot like, you've got an investor who has his or her agenda. You've got architects, you've got engineers, you've got developers, you've got the city, users, tenants, and they really don't speak the same language, but they all have to get the same thing done. So that kind of relatability, I think, and this business is super helpful.
I love that analogy. So you and Robert decided now was the time, 2020, September 2020, COVID. What was your vision, or what is your vision for Standard Real Estate? Kind of what was it when you started, and what has it become today? Maybe give us the 30,000 foot overview.
Yeah, the vision was to recreate what we had built at CBRE Investment Management now, to be diversified, but to be more nimble. At a lot of all shops, I mean, there's a box that you have to invest into, and there's an investment process and criteria. But the larger the shop gets, the more it becomes difficult to move that with the market. So we wanted to do, best in class institutional research-based investing, but be able to be more nimble to move quicker into the things that we understood make sense, as the world is turning quicker than it has been in the past. So our goal was to be JV equity investors, with the bent towards development. And we do a lot of that today. What we've added is a direct business. So today we have a fund focused on industrial development, where we provide JV equity to developers across the country. That's the current indirect business. We've done some apartment investing under that structure as well. And then on the direct side, we're focused mostly on multifamily, workforce, middle income, but really it's just regular people housing that's not brand new, high watermark rents, things that folks need to live in. So on that business, we're direct and we're the operator.
And the source of your capital today, is it primarily institutional capital, or what's kind of the general orientation?
It's primarily, if not exclusively, institutional capital. That's kind of how we grew up, is around domestic plans. We've had work with some larger REI platforms in the past, but today it's larger institutions. One of the goals in starting the platform was to bridge the gap into the retail or private wealth space. We see a lot of opportunity there, like a lot of other folks. But I think those who will be successful over the next cycles will find a way to pair institutional capital with growing allocations of private wealth across the different channels.
And in terms of, fund series and whatnot, how many are you on you're managing a closed end fund, or is it a club fund? How do you think about the structure of the capital today?
Yeah, we're investing out of, on the indirect side, a club fund with, you know, 5 to 6 domestic plans involved in that. We're in the locker room on the second iteration of that fund series. Should be broader than the current pool. We're excited to figure out how to get that done. And then on the direct side, today, we're working with one-off joint venture equity partners who are typically managed with their own funds, maybe an insurance company, but 95.5 ventures.
And this may be an ignorant question, but how should I think of a club fund versus a commingled fund, or, a drawdown fund, as some people call it in the private wealth space? Like what's the distinction there?
Almost the same thing once it's in practice. The difference would be, how it's marketed and set up. The goal would be to only have a small handful of folks versus going broad to the market and raising X amount of dollars from whomever investor. The club fund that we're investing out of is in partnership with TCM Grosvenor. They've been a veritable anchor of ours for more than a couple of years now, and good partners.
So we'll talk about that in the strategic capital angle. But look, first of all, big congrats to you and Robert and the whole team for accomplishing what you have in a short amount of time. Many of our listeners will be thinking, man, these guys launched a fund in September, launched a business in September of 2020. They've been able to raise capital as a de novo shop from institutions. How did they do that? I mean, it's a really hard environment, and the cards are stacked against new managers, even though there's a lot of opportunity, but it's very hard for new players to come out and raise institutional capital. What was that journey, and kind of what did you learn along the way?
It was difficult. That's what we learned. And it is still multiples more difficult than we would have expected. I think, a lot of folks who are entrepreneurs, if you ask them a small handful of years in, is it more or less difficult? They never would have done it if they had known how difficult that trough was. I don't know whose quote it is, but people tend to overestimate what they can do in the short term and then drastically underestimate what they can do in the long term. I think that's extremely true. We've been focused on, this is the ultimate goal of building our business and the type of investing we want to do and the type of clients we want. And then we've been pretty flexible about exactly how that looks along the way, as long as the pole is the same. I think, the other thing that I don't know if it's different about us, but it certainly is about us, is that coming from a larger shop and having been portfolio managers who ran a P&L and ran a business unit within CBRE Investors, I think that gives us a different lens and a different access point than maybe a lead deal person who would spin out, because we had text message, quarterly, email, phone calls with all of our institutional capital partners, and they got to know us and they were appreciated that we were the ones doing the work. And when we resigned, and we kind of did it Boy Scout style and did it naked, really. No capital, no nothing, which I wouldn't necessarily recommend anybody. But it's having those relationships gave us the confidence to do that. And then also we really, really enjoyed our time at CB. Robert grew up there. He started there as a sophomore or junior and undergrad as an intern in the appraisal group, and then got his first job out of undergrad as an appraiser, and then transferred to asset management, and then grew, to acquisitions portfolio manager. So he was a, younger executive MD, and we were the same age when I was coming out of business school. So the network that we got from that place, being able to phone up any broker at any market and have a rapport, I'll tell you, it was a little bit scary. We didn't know as standard if we get that same reception. Because, the joke is it's Jerome and Robert. Like they know that it's CB behind us, so they're gonna answer the phone. We were not surprised. We were thankful that those relationships and that access carried. And that's really a lot of what we trade on is the access that we have and being able to get the right opportunities for our clients.
When you look back to the earliest years or earliest days of the incorporation of Standard, and what did you get wrong? Like what did you just totally miss, other than it was going to be hard?
Two things, well, a lot of things, but two things come to mind. One is, it was the bottom of the market. It was COVID. It was the floor. And if you start now, you can only ride it up. And maybe that's true, but I didn't expect to have a 2-year cycle and then have another crash. That was one. But our product was out of the gate was a development only strategy in 2021. And while it was the bottom, like, we didn't appreciate that at that moment, investors, they didn't need to build alpha. They were just buying distress. So people, the guidance we got with it, it's just too soon to be doing development. We were stubborn about it, and we ended up getting it done. But we could have been less stubborn about continuing to knock on that development only strategy. What it did do was though give us a focus to shift and then add another business line, which is the direct business that's focused on existing product.
When you think about that experience of getting, some hard feedback, I guess, from investors, and kind of parlaying it into, version 2.0 or pivot of Standard, what did that transition require? Right. I mean, you use the word stubborn, but like, what does that actually mean? Like, what did you need to do different or stop doing in order to see the light that you needed to change directions or evolve, expand the strategy?
I think we were differentiated in our development only strategy. Like, me coming from Bozzuto, being a construction guy, like literally knowing like what kind of nails are in the building, all the way through, Robert being a PM of 5 funds focused exclusively on development. Like, that was our niche. We were trading on that strategy, and we felt like, we had a head of investor services years ago at CB called Mike McMenemy, and his thing was same but different on every fund product. He would tee them up and we'd fly in and like close the thing. Don't change on fund 3. You change one thing. You don't change 4 things. So for us as a startup, it was like, okay, we got 5 development funds. It's development. Like that's our track record. But the market needs what it needs, and we appreciated that. I think the other piece is, as a younger company, folks will say, just do a couple deals. And that became difficult to do on a one-off basis as a development allocator, because it doesn't really work unless you've got a product. Because if you add all the value you want, unless you're aggregating smaller pieces of capital that we can talk about and then putting them into one larger deal, invariably at point of sale, when you've got a developer and you've got an investor who's one ticket and you're in the middle, it's like, well, what are you really doing here? Unless there's a portfolio component to that and a fund product. So going direct enabled us to also have individual one-off JVs without a product, which I think has given us that balance.
So one of the biggest kind of chicken and egg scenarios that I hear and see with the folks that I talk to is institutional capital says, we'd really like to find the next gen, the emerging manager, the specialist, the sharpshooter. Use the word development, alpha. But these shops are so risky. They have no experience doing this. Are they going to be successful? And, there's this like constant, give and take. You found a capital partner, it sounds like, in GCM Grosvenor. Maybe talk to me a little bit about what you needed, and then what you learned the market was willing to provide to you as a strategic capital partner to help get the business going.
Yeah. And it's 2020, I'm checking the calendar, 5. And as much as, we have technology and access and all the things that we have today, I do truly believe that real estate is still a people business. That may change at some point, but it's not quite there. And people kind of do what they want to do. And then in my experience, and they use the data or the information to validate it. So for us, it was finding the right people who believed in us and believed in our track record. And then we would also have to have something that they wanted, but having something that they want is that's just part of the sell. And then once you find folks who appreciate how you think about the world, how you invest, how you built your firm, then you can workshop, the right investment strategy. So I think for us, it was people first. All of our clients are first their relationship clients, and then whether they've changed shops, to person, and then you find that overlap. I mean, for us, we treat most of our clients, even the one-off JVs, almost like separate accounts. Now there's operators that like have a deal. I own the dirt. I bought the thing. It's the best thing. I'm sharpening the stone, and then I got to go find my feedstock for the thing, which is the capital. Like that's one way to do it. The other way, which is our way, is you survey the market. There's trillions of dollars and all kinds of companies. Like, who do you want to work with? Who wants to work with you? Who thinks the same way? Who's going to act the same way when things go sideways? Who values you and vice versa? And then, okay, what are you looking for? What can we do? Where's the overlap? Great. Let's go find that thing. And that's really, it's an investment management capital client business as much as it is, if not more so, than it is a real estate business where, the real estates are just the widgets, candidly.
So the capital is obviously important. What else kind of has been important to you in that relationship? Or is it really primarily about the capital? Obviously, you just spend time talking about the people and the importance of that. But like, are there other things that a partner was able, GCM in particular, was able to provide to you that you may not have had on your own or couldn't have gotten there as fast? Or is it really just about kind of the strategy and capital side of things?
Well, you mean the emerging manager ecosystem generally, which they're squarely in the middle of, I think is a tool and a system that works really well for the right kinds of firms. And we have, investors and plans on the platform that talking to a GCM to, 18 months, 2 years, but talking to some of these clients direct takes 5, 10 years. And we're currently on their platform. We could go to their office. We talk to them. We know them. And we're invested and have return track record with them. So that kind of access, be it like indirect technically, is worth a lot if you're trying to ultimately scale your business and have more of those kinds of groups on the platform. If you're somebody who doesn't want to do that and wants to do a small handful of deals and make, the right amount of money over a series of investments, then like maybe that's not the right path and could be a lot of work that doesn't need to be done. I think the other piece is having gone through institutional diligence processes on our prior product at the old shop. We were startup company. We had done all that stuff before and knew what it was supposed to look like and had those conversations. So a lot of the how do you become institutional, we knew already.
So let's switch to what you're doing today. Standard real estate, investment manager, you have an indirect business, you have a direct business. Why are what makes you what's your edge? What makes you different? How do you think about what you're doing relative to what everybody else is doing? And where are you head and shoulders, above your peers, if you will, or have a different approach to your peers?
Yeah, I alluded to it earlier, but I think it's a client first, client service approach to the business as opposed to like operator only approach. Even when we are the operator, I think that's one. Two is our team. You mentioned Robert and myself, but we also have Shubra and Lindsay came from CB with us. Shubra was our lead research person at CBRE. She was a 20-year person there. So that was our first hire. And I think our partners really respected the fact that our first hire was a principal who would lead our research department as a startup. And it just set the tone for how we operate, how folks view us and how we invest. I'm traditionally, all over the place and I've got deals here and she'll shut me down 70% of the time because it doesn't make any sense, which is great. And that's why she's here. But really being able to think about markets, capital flows, we'll give the same types of market update, state of the union type house view presentations to our clients periodically. And they'll call in 50 people and sit and listen over Zoom or in person to what she thinks about the market and what our house view is because they value that information. So that's a differentiator. I think being diversified and national is a differentiator. I think increasingly, there's two ways to do it. You can be a sharpshooter and be vertically integrated in a market, which is great, but until that market isn't performing or that product type isn't doing what it's supposed to do, I think for us, we trade on the ability to think about structural changes, find the right pockets, execute, be nimble, move quickly, access opportunities. And then when those opportunities are no longer available, be able to flex into, like today we're 90% industrial. 8 months from now, it could be the opposite, 90% multifamily. But we have that option. And I think that's a differentiator as well.
So, a logical follow up might be small shop. How are you good at both industrial and multifamily with, relatively limited resources? How do you think about using those resources to get that edge?
Yeah. Well, on the indirect business where we're investing joint venture equity, it's all for development. And we have development partners that are local to the market, be it national firms or regional firms, but they have a local business unit in that place. So it is, from our perspective, an investment activity more so than an operating activity. And then on the direct business, we'll pick our markets for specific reasons, but we're heavily focused on DC, Maryland, Virginia, and Chicagoland right now. Markets we've done over the years and in our careers, lots of business across industrial and multifamily. But you won't see us do firehouse convert to condos. Like, you're not going to see that out of us. You're going to see core plus at an off-market basis in a misunderstood market that's trading 25 basis points wide of where it should, with a light value add and some leverage that gets you a super clean, low risk value add return with a light business plan on the good buy. Like that's what you're going to see from us. And then on the development side, the higher octane investments, you're going to see an allocator into a shovel ready development deal with a local operator. When I say local, I'm talking, Fairmont Ryan Company, those kinds of legitimate companies. So the access point, a lot of smaller shops, it, I don't know how they get on that list of equity partners for some of those larger groups, but we've been able to port that access from CB and the relationships we built there too. So that's how it's a barbell approach, kind of core plus, light value add on direct, and then development with a partner.
So if an investor's thinking about a relationship with you, hypothetically, are they thinking about your strategy as, I mean, the development is likely an alpha generator and the core plus might be more kind of a diversifier? Am I thinking about the right way? Or kind of what have you learned from your conversations with investors, how they view your shop and your strategies as it fits into their portfolios and their needs?
I think on the direct side, where we are working with JV equity partners who are allocating to us, they value the access and the sounds trite, but like the investor speak, like we sit in that chair and we've sat in their chair and we know like what they're looking for. Maybe not the specific deal, but we know the kinds of things that sound like that's BS, or we know the kinds of things that are, it's a great deal, but I don't care. I don't need to get a 22 on this deal. I need to make sure that I get a 15 or else. And it doesn't matter that it's the best asset of all times if my committee member got burned in that, you know, city 2 months ago, I can't do it. And instead of saying that's doesn't matter, having 9 more conversations, like I get it. Like there's a process that's more than just what this asset is doing. There's a whole ecosystem around how to get an investment from source to close that makes sense and it is a good investment. So being able to workshop and sit on the same table with them, I think is what they value on the direct side. Indirect side, I think similar, but access to development and we're active management. Like we just sold our second development transaction and it was a great one. But there's things that happen during the course of a development that it's not just set it and forget it from a capital standpoint. And a lot of our clients, they want set it and forget it development. And we're that in between layer that helps them find the right investments, but also work with developers from folks who've been doing it. That's all I've ever done. So we know that things don't always go right. It's about fixing them. So, when you combine those two things, I think what you'll get is kind of a core plusy cash flow, plus higher octane, maybe some J curve, but more appreciation. And you blend them. It's kind of like some 20s plus some 13s equals a 15, 16. Like that's, our barbell strategy across the platform.
One thing that stands out in this conversation is you really know kind of what your swim lanes are, right? I mean, you're talking with a lot of specificity around what it is that you want to do, how you want to do it, what you expect from it. And I think that's a really important learning for our listeners who are maybe just getting started is you can't be all things to all people, right? And you're kind of clearly defining what it is that you do and what it is that you don't do and what's expected from what what your return expectations are, which I think is really important. So as you look forward, you mentioned your house view. What is your house view today? This is being recorded in, February of 2025. We don't need to get overly tactical, but like thematic view, not, next 3 months, what's going to happen with cap rates and market X, but thematically, where do you see things going in the markets that you serve and how might your strategy evolve as the future outlook evolves from your house view perspective?
I think, a little bit to your lane point, there's a lot of niche products that are becoming more mainstream, which I think is great. And a lot of folks are flowing into those. We don't have any beef with those, but I think we kind of know what we know and know what we don't know. We're going to leave those kinds of things to others. So I think you'll see us stick to major food groups. Today, that means industrial and multifamily. I think just the structural undersupply of housing generally across the different property types, be it single family, multifamily, for sale, for rent, senior, student, like all of those things combined, like housing is a thing. It literally, and in a world where the technology is going up place, I don't know. It's quite really the only thing that you actually need is a place to put your body. And like, that's going to be the case. and it's not going to be any more affordable than it is today. So finding ways to activate housing as the market allows you, I think I think makes sense. Understanding like the nuances of local politics and regulations, I think not to trade on that, but there's just so many groups that don't have an appetite to even understand what's happening in a market. If a headline says there's rent control or there's this kind of risk that something becomes regulated, a lot of folks just they have too much capital and not enough time to worry about understanding something that isn't very very obvious. Maybe that's at the top at leadership. Maybe it's the analyst who's taking the deal flow and they don't want to play to their boss, so they just don't do it. But if you can understand, even at a cursory level, how to activate in those markets when those kinds of risks are priced in, I think you'll do well as the market becomes more and more receptive to things that will be regulated over time. So that's like a theme we think about. But really, it's just structural trends that we try to trade on.
And as you look at the next 12 to 24 months, should we see anything different from Standard? Is there, you mentioned you're going to kind of stick to your lanes and what you know, but from a business perspective, kind of anything you're excited about or that's on the horizon that you can share?
Yeah, I think we're in the business of managing capital and client service, so we're going to continue to do that at a broader scale. So want to still be relevant in the capital markets. But no, I think this is the year of just getting business done. We're at the place in the business where we were trying to figure out who we were, doing a lot of startup, a lot of infrastructure, trying to find our first clients. And I mean, there's still work to do by all means, but I think now is just do the work. I'm looking forward to that, but it's just doing the work is what we're going to be doing over the next 12 to 18 months.
If people are interested in learning more about Standard, whether it's on the indirect side because they're local operators or they have deals, or it's on the direct side because they want to learn more how they can be a part of your story, what's the best way for people to learn more or get in touch with you or a member of your team?
Yeah, you can go to our website. It is standardrei.com. And then there's a general email that we keep. It's investors with an S at standardrei.com. And that goes to all the folks that it needs to. But we're open. And I'd say half of our business is inbound and half of it is external. It feels good to have folks reaching out and wanting to work with you after being a person who was dialing for dollars, as a two-person company that's now much larger. I still dial for dollars, but you get the point.
Awesome, Jerome. Well, thank you very much for joining me. I've loved this conversation and all of our conversations, and congrats to you and Robert and the whole team at Standard for what you built, and really excited to continue to follow your story. So thanks for joining me today.
Perfect. Thanks for having me.